podcast with our host, Ed Lyon. Ed, today's Q&A from your listeners. And it's been great, the feedback you've been getting so far about the podcast, right, Ed?
It's been terrific feedback, and I'm surprised that I've gotten some questions that have found me through email or through LinkedIn or various ways. And it wasn't something that I anticipated, but it's something that I really do welcome. I would love to know that I'm answering questions that people submit to me because that means I'm giving them the information they're looking for, as opposed to me thinking that I know what people want and just guessing on it. So yeah, I want to make listener Q&A a regular part of the program, maybe every month or so. We'll see how often we get questions, and let's have fun with it.
Now, I'm excited to see some of these listeners. So the first question is, I see lots of posts online, especially on social media, on how to pay less tax. How do I separate the truth from the hype? Are the things like the Augusta Rule and short-term rentals real, or are they just trying to sell me something?
Right, it's a great question, and it's a completely legitimate question, and I could spend an entire afternoon talking about this. So let's back up a step. There is a ton of content online about paying less tax. Some of it is really good content from legitimate experts. Some of it is slightly misinformed content from people who are expert in something else. For example, you might see a real estate investing guru talk on their podcast about taxes. Hopefully, they've got a tax expert. Otherwise, they may know enough information to be dangerous. And then there's some stuff that is out and out scams. Just there's scams in every corner of the internet, and a lot of what you see about tax planning is just scammy. So, how do you separate the good from the bad and the ugly? The first thing you've got to do is ask yourself, who is it that you're listening to? Are they a credentialed tax person? Meaning, are they an attorney? Are they a CPA? Are they an enrolled agent? You really want someone who's got some technical tax credentials. It doesn't guarantee that what they're telling you is right or right for you, but it gives you a fighting chance. There's a better chance that someone with the right initials behind their name are going to be knowledgeable enough to tell you. So that's the first screen. The second screen is really to look at what their incentive is. What are they posting information for? What are they looking to sell you? There's nothing wrong with trying to sell somebody something on the internet, right? You and I both do it every day. So what's their incentive? Are they a working CPA in your community or in your target market who's looking to bring clients in the door? That's absolutely legitimate, and I think from the tone of the question that it implies that there's something wrong with trying to sell somebody something. And there's not. I am a salesperson first and foremost. I can know everything there is to know about taxes, but if I can't find somebody who's willing to pay me for that knowledge, it's not going to do me much good, right? Same for you. You're an expert in marketing. You're not just a podcast producer, you're a marketer and you're a marketing consultant. You got to sell your services, right? And
Right.
how do you do that? By showing people that you can do what it is that they're looking for you to do. So that's the second piece. And let's get into a little more detail there. There are legitimate tax planners who are looking to bring clients in the door. I think that's a perfectly acceptable scenario. There are people who are looking to sell products. That's slightly different than looking to sell tax planning service. So if you're a product seller, if you've got, for example, a leveraged equipment leasing program in, I'm just making this up, in the tiny house space, then you're going to look to sell your tiny house program to as many people as you can find. And that may be great if it's an appropriate program for somebody. If it's not an appropriate program for somebody, then what is the vendor doing? Are they still trying to sell it, or are they moving on to talk to somebody else? What I would say is that using the internet to generate as many leads as possible is actually a pretty good sign, because then you can be picky about those leads. So if
Yeah.
I'm looking to sell a program and I've only got 5 people to talk to, and my income depends on selling the program to all 5 of them, that's going to be a very different situation than if I have 100 people to talk to and I can pick and choose. So here's the thing about strategies: it's not whether something is the right strategy, because there really is no such thing as the right tax strategy. It's whether it's the right fit for you. And someone who has the luxury of picking and choosing their clients is less likely to try and sell something simply to make a sale. And then finally, there are some areas where there really is a lot of shenanigans going on. The area that comes to my mind first is trusts. And I see a lot of Instagram posts on here's my miracle trust. Now, trusts are a perfectly legitimate tool. I've got a trust of my own. Anybody who's done sophisticated estate planning has a trust. It is a totally legitimate tool. It is essential in most cases for transferring assets to the next generation. They can be very helpful in the asset protection space, but they really aren't as helpful as most people think they are in the income tax planning space,
Mm.
because the trust is ultimately going to either pass the tax through to the beneficiary of the trust, or it's going to accumulate income and pay out at trust tax rates. But there are a lot of people online who will tell you that their trust package will help you pay less tax. Those claims are often overstated. I want to be really careful here, because at some point, someone who sells trusts is going to watch this podcast. And I don't want to lump all trust people in the same basket, but there are a lot of people online selling a lot of really abusive trusts. And if you get an offer on a trust, reach out to me here at the Lion Share podcast, and I'll take a look at it and we'll see if it looks legitimate or not. But if the video, talking about the Augusta Rule is legitimate. Talking about, what was the other topic in the question?
Yes, we go. The Augusta Rule is one of them. Also talked about short-term
Oh,
rentals.
short-term
Real.
rentals. Yeah, I
Yeah.
see. I see a lot of videos about short-term rentals, and short-term rentals are very popular because they are the easiest way for someone who has a big salary to use real estate to pay less tax. If you've
Mhm.
got a regular long-term rental, the long-term rentals are governed by different rules than the short-term rentals. So short-term rentals, one, give you the opportunity to take those depreciation deductions, and two, they let you use 100% bonus depreciation when you buy a property to write off a large chunk of the property's value immediately. So those are legitimate strategies. However, will short term rentals let you eliminate your income tax completely? Probably not.
No.
Probably not. So you've got to ask yourself, does this sound like sober analysis, or does this sound like hype? If you've got somebody who looks like the old Crazy Eddie appliance commercials in the 1990s, buy your short term rental now and wipe out your taxes and do this, the underlying strategy may be perfectly legal. And in the case of short term rentals, yeah, it is legal, it is legitimate. A lot of people are doing it. But is it going to deliver all the promised results? Hopefully, this is not your first time on the internet and you have some experience in life sorting through legitimate claims and hype. You must see a whole lot of hype in
I do. I
you're an
do.
extremely online person, but how do you look at claims, not just tax claims, but investment claims,
Oh, it's ridiculous.
hair replacement
Mhm.
product claims, which I'm going to have to start looking into myself. I'm trying to go a different direction than you. I mean, how do you evaluate any claims online? You're an extremely online guy. I want to hear your input.
So that's a great question. And I think a lot of it I see is because I'm targeted by marketing and these guarantees that we're going to increase your followers by 500,000, or we're going to get this many video views for you, or we're going to decrease your ad budget to this price and you could be paying only $100 for SEO instead of $2,000. All of these claims right up front, you have to do the smell test, guys.
Yeah,
And
smell.
that's the smell test. And the first smell test is go check out the reviews.
Mhm.
Also, because this is the thing, when you advertise on Facebook, you better have a online presence with reviews and different things if you want to do this type of advertising. That's the big thing. So first you check the reviews, you check the claims, you see these, you
Yeah,
throw it in AI, you go all these different directions, say, is this too good to be true? It probably is. And then you go ask AI, and if AI says it's a complete scam, you're out. Thank goodness for AI, but don't always guarantee AI. Give them all the facts. Look at the
right.
screenshots.
Give the
Here
facts.
now,
Under
Trustpilot's one that I don't really trust much, and I'm learning more and more. I see these Trustpilot reviews, and I don't know if I can really trust them. It's not.
Trustpilot a pay to play? Is that JD
It's not a
Power?
pay. It's not a pay to play, but they do reviews. You are paying, I guess, to get the reviews. But I don't. I see so many people that have Trustpilot reviews. They say they're touting all these things and they never accomplished any of them. So there must be a way to scam the system. And
Mhm.
reviews can be scammed. So after you see reviews, the next thing you say is, I want to talk to one of their customers. I want to talk to somebody who has seen the same success, can tell me straight out, and I can verify it.
Yeah.
And in the industry you're in, Ed, it's so important because if you're going to go buy a trust or you're going to, I mean, invest in a trust, if you're going to go ahead and, do a foundation or do some sort of these plays, you have to see the satisfied customers because you could pour a ton of money that you didn't pay the IRS, but guess what? Who you paid?
Right.
You
Yeah.
paid that person, not the
Right.
IRS.
But you're still out the money. So
Right.
my whole business is built around the premise that you'll pay me less than what you pay the IRS. But I have people Google me and ask AI about me, and they will tell me here's the due diligence that they did on me before they're writing me a check for $30,000 or $60,000. But you're right. Does it pass the smell test? Ask AI. Over Thanksgiving weekend, a colleague called me. He wanted to talk about a program that he had joined. It was a crypto program that involved buying nodes and staking and some other stuff. And it just didn't sound right to me. So I asked, and in this case I used ChatGPT, but I asked ChatGPT, is this program a Ponzi scheme? And it said, I can't tell you that it's a Ponzi scheme, but here are the things to look for. And reading between the lines, ChatGPT was telling me it's a Ponzi scheme.
Yep.
It didn't want to come right out and slander the Ponzi scheme or the head of the company who had fled to Sweden and changed his name before coming back to the United States. That was the first clue for me that maybe this was something that I
Yeah.
didn't get involved in.
And there are some big time players out there doing tax strategy that ultimately are going to give you the same thing that a regular accountant would give you. They just are going to pay. You're just going to not going to pay that accountant. You're going to pay someone online to do it.
Yeah, so obviously, if you're getting more value than from your accountant, then great, you're getting more value. I know that there are a lot of people who use Kevin O'Leary's firm.
That's why I was going to mention
Yeah,
that.
Tax Hive. And I have never done business with them. I don't know what the quality of their support is like, but I have had conversations with people who have come to me after going to them and saying, "Hey, they did recommended this, they recommended this, that they introduced me to hiring my kids, to the Augusta Rule, to some other stuff, and it is all legitimate stuff." It is all legitimate. Kevin O'Leary is a guy who does not need to attach his name to something that is scammy. So his ads are legitimate. His service is legitimate. I'm not saying go to him instead of me. People come to me because they think they've outgrown that level of support. Kevin O'Leary was great for me when I was making $200,000 a year. Now I'm making 800 or a million. Is there something more that I can do that they're not showing me? So different vendors are right for people in different phases of their business or their career. So that's a really long-winded answer to the original question, which is the short answer, the too long didn't read version is Most of the strategies that you will see are legitimate. Some of the claims that are made about the strategies may be overstatements. Use your nose, make sure it passes the smell test. Don't be afraid to bring in other online resources, and don't be afraid to ask your own accountant, your own attorney, your own people who are successful financially in your life. I would also just add, be careful taking financial advice from somebody who's not as financially successful as you are. A lot of people will tell me, I've had a couple of people tell me, well, my grandpa said I should be happy to pay taxes because that means I'm making money. And my response to them is always, well, was grandpa rich? Well, no. Okay, well, I certainly hate to discredit grandpa. We all love the old guy, but maybe he's not the right person to take
Exactly.
financial advice from 40 years after he retired.
All right. Next question. Is there still anything left I can do this year to pay less?
Okay, so we're recording this podcast on December 3rd. There is not as much available to do as if you had come in July. So this for me is silly season. I get a lot of people coming to me in December who are hoping that I can pull a rabbit out of a hat. And I can recommend some legitimate strategies. I have a call tomorrow with someone who sold a business in August and is just now looking for some last minute tax planning advice. So I can talk about moving proceeds from the sale into a qualified opportunity fund, and we can still do that in December. We can talk about a charitable lead trust. We can still do that in December. There are a couple of product-based programs that are available for another week. But if you're going to take advantage of that, you've got to be able to make a decision very quickly. And most people can't do that. So if the same person had called me on December 27th, I think I would have said, I'm sorry, there's nothing I can do now that I can't do in January. Let's have a conversation in January. People are coming looking to pull the rabbit out of the hat. It reminds me of the old Star Trek lines, Dr. McCoy, I'm a doctor, not a bricklayer. Well, I'm a tax guy, I'm not a magician. Can you do some things? Yes, it's going to depend on your own personal circumstances. So I can't say here is a list of 7 or 8 things. For business owners, you might consider adding a management company or captive insurance, although it's probably too late to start with captive insurance this year. For high-income W-2 earners, oil and gas is always a reliable investment opportunity. You put a couple $100,000 into an oil and gas program, you're probably going to be able to deduct 160 or 180,000 of that, and most of those programs are open until December 31st. In fact, they will be happy to take your wire transfer at 4 p.m. on December 31st. But it's time to get moving, and it's time to adjust your expectations down.
What's your favorite tax move?
So I love this question, and it depends on who the client is who's asking me. But I will tell you, the one that I have been doing the most with right now is with business owners, and it is something called a management company or a C corporation ride-along. Most of my clients who operate their own business operate pass-throughs, proprietorships, partnerships, S corporations, where the income gets passed through to them and they pay individually on their own tax return, typically at 37%. Well, a C corporation can lower tax on current income to 21%. A C corporation can move taxable income from 2025 into 2026. And if you operate some businesses as a C corporation, you can sell them tax-free down the road. So it really is kind of a Swiss Army knife of tax strategies that can accomplish a lot of different goals. A C corporation is black letter law. If you're moving money from, say, an S corporation to a C corporation, you've got to be able to justify a non-tax business purpose for the transfer. And if you're accumulating money in your C corporation, you've got to be able to justify those accumulations. That really isn't all that difficult to do. So a lot of stuff that you can do. A lot of CPAs that I run into still don't like C corporations. They've spent the last 30 years thinking that C corps are bad because of double taxation, but the rules changed in 2018 and not everybody has kept up to date with all of the changes. The big beautiful bill this summer created some new advantages for running businesses as a C corporation as well. That's the one that I'm having the most fun with my clients.
It sounds like, I mean, for sure. And it's fun coming up with figuring out these certain different strategies and having your favorite one. And
It,
that one's more of an accountant one for sure. It's not an,
it is more of an accounting one. It's not a sell a product. I
right.
like some of the sell a product strategies, but you have to be very careful with them. So the analogy that I use with my clients is there are different chassis for tax reduction strategies. One of them is buy equipment for a small down payment, take advantage of 100% bonus depreciation to write off the full price of the equipment, and then lease it out to somebody who will pay the debt service on your. So that's the chassis. The chassis is very straightforward. There's no doubt that you can take 100% bonus depreciation on qualifying assets. However, the nuances are important. So in most cases, you're going to have to materially participate in the business and be able to show, if you get audited, that you spent over 100 hours a year in the business. That's a potential avenue of attack. Other leveraged equipment leasing programs use something that I call basis inflation. Instead of selling a product for the real price of the product, they'll work up a discounted cash flow analysis and they'll sell the product for 5 times the retail price of the product. And that becomes your depreciation deduction. Obviously, you're getting 5 times the depreciation, but is it a legitimate price? And the IRS can and does have a history of attacking valuations and knocking down those deductions. So the chassis is legit, but the program has to operate legitimately within the chassis. It's a similar story with leveraged charitable donation programs, which I have done personally myself. There are programs out there that are terrific, and there are programs that don't rest on a solid foundation. So the product, those are the fun razzle-dazzle programs where somebody says, oh, that just sounds too good to be true. And you know what? Maybe it's not the right fit for you.
Because there's more work involved. It's nothing is just as simple as it's not cut and dry at times, for
They
sure.
are rarely that simple. The leveraged charitable donation programs are certainly the easiest. But again, you've got to make sure that you've got a vendor who does their homework, and you want somebody who's buttoned up. You want the right legal opinion letters. You want somebody who does it right, not a fly-by-night operator. You see people in the marketing space who do it right and deliver tremendous value to their clients. And in the same space, you see people who are fly-by-night. They're not scams, but they're just not dotting their I's and crossing their T's, and they're not ultimately going to be able to deliver on the promise. Somebody who says they can take my $2,000 a month SEO budget and knock it down to $100 a month, I'm interested in that, but what am I going to, if I hear an offer like that, well, first of all, I don't need to talk to those people because I've got you, but I would bring a program by you and I would trust your judgment because you're in the space and you know which programs are
Right.
good, you know which ones aren't.
And it's just all a process, and you never know with those things. So, what do you think about what's happening inside the IRS right now? We're even seeing news happening as before this person asked this question, from the president as well. What can we expect for the next few years?
So here's the thing about the IRS. Everybody loves to hate on the IRS. Everybody loves to beat up on the IRS. And they're the convenient scapegoat because what people really don't like is paying taxes. And the
Right.
IRS does not make the rules, they just enforce the rules. They try their best to enforce the rules fairly and even-handedly. Sometimes they're a little overzealous. But the IRS, the people who work at the IRS, for the most part, are civil servants who are working a really tough job with no respect and not as much pay as they could get in the private sector. So that's our baseline coming into this discussion. When we started 2025, we had about 100,000 people working for the IRS, and that was understaffed for everything the IRS does. Since then, DOGE kneecapped the IRS. We lost about 25,000 employees to layoffs and buyouts. And a lot of the people who took the buyouts were the most experienced people working for the IRS. And then the IRS got even further behind the ball with the government shutdown. So the IRS laid off thousands of employees. The IRS, you can think of them as having two different sides. One is the we collect money side, and the other is we pay out money. Well, who are we going to keep during a government shutdown? We're going to keep the people who collect the money, and we're going to lay off the people who pay out the money. But here's the real distinction. The IRS has a couple of different focuses, and we talked about this 3 or 4 weeks ago when we walked through the demystifying the IRS presentation. So you've got two sides. You've got the customer service side, and you've got the enforcement side. And what people really don't like is the enforcement side. They don't like the auditor who makes them drag in a foot-thick pile of documents. And they don't like the collection agents who send the nasty grams saying you still owe us $12,000 from 2019. So politically, it's attractive for lawmakers to say we're cutting the IRS budget, we're cutting out the waste, we're cutting out the fraud, we're cutting out the abuse, and by cutting the IRS budget, we're cutting their ability to harass. That's a pretty attractive political message, right? We're gonna get the IRS off your back. The problem is when you cut the IRS budget, you're not just cutting the auditors, you're cutting the people who answer your phone call when your refund doesn't show up. And so you want the smallest, least intrusive IRS possible, but when something gets screwed up in a computer and a human being needs to look at it, you want good customer service. Those are two pretty irreconcilable goals, unless Congress does a much better job of allocating revenue to one side versus the other side. Back in 2022, the Inflation Reduction Act added $80 billion in IRS spending over 10 years. Social media went nuts, and people, particularly on the anti-government side of social media, said that the IRS has $80 billion. They're going to hire 87, the number I think was 87,000 gun-toting new agents to track down grandma's lemonade stand. And of course, that simply wasn't true. First of all, it was $80 billion authorized over the next 10 years. And that meant that Congress could choose to spend $80 billion over 10 years. Congress was under no obligation to do that. That's $8 billion in new spending a year. Yes, let's hire 87,000 people. Most of them were going to replace people who retire over the next 10 years. And by the way, less than 3% of the IRS employees are special agents. They're the ones who carry guns. Sometimes, not all the time. You don't need to pack heat in an IRS office when you're doing desk work. The Democrats in Congress and in the White House tried in good faith to give the agency funds to continue operating at the same level of service over the next 10 years. But it's so easy to beat up on a congressman who votes for IRS money. It's so easy to vote against a president who supports more funding for the IRS. Well, we're trying to strike a balance here of enforcement and not letting the bad guys go, and customer service. It's a hard line to balance. So I think what we can expect, the direct answer to the question is we can expect that the IRS is going to be a hot mess. They just don't have the money to hire the people to fix the problems, and it's a hot mess already. It's probably going to be a hot mess through the remainder of this presidential administration and until we see either A, significant technology upgrades, or B, significant additional staff.
And this is very interesting, and we'll see in that whole IRS news, especially on the Lion's Share podcast. How much do I have to be making? This is the next question coming. Very interesting. How much do I have to be making in order to start thinking about tax planning?
That's a really good question. So the short answer is it depends on your personal circumstances and how you earn your income. Business owners can start benefiting from tax planning at much lower income levels. If you're earning $100,000 from self-employment, you really should be looking at things like the Augusta Rule or an accountable expense reimbursement plan or hiring your children or a medical expense reimbursement plan for your family. Those things aren't going to make you rich, but they could cut $10,000 off of a $30,000 or $40,000 tax bill. So as a business owner, it behooves behooves you to start looking for tax planning as soon as you get your head above water and you're running a profitable business. For someone whose income comes from a W-2 or IRA, pension and Social Security income, you really don't have the same kind of opportunities to save that you do with a business. However, once you hit the 32% tax bracket, then we can really start looking at some profitable opportunities to offset that income. And that's where the product opportunities like a leveraged equipment leasing program or a leveraged charitable donation come in. For most families, that's probably going to be somewhere around $500,000 a year, where we can really start making a difference. Now, understand that's a particular threshold for me. So I operate in a particular fee environment. Somebody who is a proactive CPA, they're going to be less expensive. And if you spend less money to get into their business to hire them, then those income thresholds can come down. So I don't personally work with business owners who are generating, say, $120,000 or $150,000 for their business. But just because I don't work with those clients doesn't mean that you can't find somebody who does work with smaller businesses. And particularly if you're a business, accountants, here's a dirty little secret. They're really not interested in making money from your tax return. They are going to make a lot more money doing the accounting work for you. They like the predictable recurring monthly revenue, and accounting work is easier to manage than tax work. So if you have the opportunity to give a CPA your accounting work in addition to your tax preparation work, you're more likely to get a good result with them. If you're a doctor or a lawyer or an Indian chief working on a W-2, you're not going to have the opportunity to bring that accounting work to them. The tax preparation becomes more important. But when you're talking with a potential accountant, ask them, who do they work with? Who is their ideal client? The further you are from their ideal client, that's when you start asking, is this really a right fit? And it's not, is this a good accountant? Is this a good accountant for me?
All right. We had to pick through a bunch of them to find the best. Our final question for today, and I look forward to next month in January to introduce more questions.
Mm-hmm.
So people need to find you in the Lion Share podcast. Drop DMs, emails, whatever you can. Sure. For more questions. Here's a great
Carrier
question.
pigeons, smoke signals.
Exactly. Write a review and then write a question. That's even better. Write an Apple Podcast review, hit like on Spotify, subscribe on YouTube, and send us your question, and we'll definitely play it on the air. The last question is, I looked at a program earlier this year that involved buying solar energy equipment to lower my tax bill. I didn't feel comfortable with it, even though my business partner liked it. Am I just worrying too much?
No, you are not just worrying too much. So we've touched on this with a couple of the other questions that we have answered. So the world is full of people who would love to make money by helping you pay less tax. I don't know how many of them in the tax podcasting sphere will admit it as directly as I just did. World is full of people who want to make money by helping you pay less tax. They have all sorts of different programs. The question is not, is this a good program objectively? In many cases, it's not, like the crypto Ponzi scheme, and you can dismiss it and you can move on. But in other cases, it's a legitimate program, but is it a right fit for you? That's the real question. So I have clients who will look at a program. First of all, I'm going to present multiple programs. That's the advantage of my approach. My approach is holistic. It's top down. I'm never going to bring a client one program. I'm going to bring them a whole comprehensive set of programs so that if there's something they don't like, we can move on to something else. I don't call my clients wussies when they don't like the programs that I show them, because they are not the right fit. So there could be a lot of reasons why you might look at a program and say, it's just not the right fit for me. Maybe it's an equipment-based program and it requires a personal guarantee on the equipment, and you don't feel comfortable offering a personal guarantee on something that you don't have control over. That's totally understandable. As far as investments are concerned, some people put their money in bank CDs and some people buy crypto. And we can't say that one or the other group is wrong. They're just going with the most appropriate fit for them. So in a lot of these programs, you really have to be looking at the investment first. With oil and gas, You don't just pick any oil and gas program. You look for an operator with a proven track record who has made money for their customers in the past. And if that's a good fit for you, terrific. Other people would look and say, you know what, I don't want to be in the petroleum sector because, of whatever reason. And they don't need to give a reason. If a tax strategy is going to keep you awake at night because you're worried that it's a bad investment or it's going to expose you to audit risk, then don't do it. I'll tell you what I think my best estimate is of your odds of being audited and what the consequences are of being audited. But if you don't feel comfortable with something, don't move forward with it, and don't let your partner or your spouse or your brother-in-law or your drunk uncle at Thanksgiving tell you otherwise.
Yeah. Great point. Because if you don't feel comfortable with it, it's just going to eat at you.
It's going to eat
And
at you.
you're going to worry about it, and you're probably worrying the right reason to worry. There's no
Yeah.
reason to worry, but if it's going to cause you to worry,
If it's going to cause you to worry, then don't do it. Let's talk about something else. I had a conversation over the last couple of weeks with a prospective investor. He's a Wall Streeter. We went through a bunch of different programs. He said, of one program, he said, I like one chassis, but I wonder if some of the sponsors are flying a little too close to the sun. And my response to him was, look, you're a sophisticated Wall Street guy. You've got a PhD in economics. And if something doesn't pass your smell test, don't buy it.
and that's the big thing. So, wow, this is so informative. I think these are such great questions. And definitely feel free to reach out to me if you're listening to the Neil Haley Show and say, hey, I have a question and you want to DM me. I'll make sure those questions, and I'll keep a lookout especially with these comments on social media. I bet you I'm going to be targeted by a lot of tax ads in the next couple days now, because we just talked about this.
Sure.
And I have multiple devices, and that's part of it. But we'll find those. And if people have questions, we'll definitely put them on the Lion Share podcast.
Yep. Thanks, Neil.
All right. Thanks, Ed. All right. That was a special simulcast of the Neil Haley Show on the Lion Share podcast, guys.